Don't refresh the page. Don't assume your chart is glitching. What you're seeing is real. Silver didn't move up today. It jumped. Not a cute little rally. Not a slow grind. A jump that only happens when the market's normal plumbing starts to choke. Here's the headline everyone's going to repeat. Silver is up. Cool. That's not the story. The story is how it got there, and what the rest of the world is paying right now while your screen is still catching up. Because when silver rips like this, it's rarely just excitement. It's usually pressure. And pressure leaves fingerprints. Look at the pace. Look at the size of the move. Markets don't casually do that on a random weekday morning unless something underneath is forcing the issue, liquidity disappearing. Sellers stepping back, shorts scrambling, dealers hedging, risk desks hitting the panic button. That's not hype, that's mechanics. And if you've been waiting for the moment where the tape stops acting normal and starts acting like a stress test, this is it. Normal markets don't gap and sprint. Normal markets don't feel like they're skipping price levels. When they do, you're not watching a chart pattern. You're watching the order book thin out and snap. Now here's the part most people miss because they're locked on one quote: the spread. The gap between what you see in the West and what the physical world is signaling elsewhere. We just got fresh numbers out of Asia, and while US traders are celebrating the print on their screen, buyers over there are paying more. Enough more that it's not noise. It's a message. It says the physical layer is tighter than the paper layer wants to admit. And that's why you need to stay for this breakdown. Because if you only watch the headline move, you'll get faked out, again. But if you track the signals, spreads, premiums, inventory drawdowns, and forced buying, you'll understand why silver can explode, and why it can snap back just as fast. There's still a gap, and as long as that gap stays open, the market isn't done talking. Most people will watch the headline and miss the signal. Silver rips, the chart lights up, and the entire internet starts chanting the same two words: breakout and moon. But that headline move isn't the story, the spread is. Because one screen can lie to you without ever printing a false number. A neat quote with 2 decimals can still be the wrong reality if it's the wrong layer of the market. The real question isn't, did silver go up? The real question is, where is silver more expensive? And why? When Shanghai is trading meaningfully above New York. That's not a trivia detail you mention in passing. That's a stress flare. That's the market telling you the physical pipeline is tighter than the paper tape is willing to admit, or able to price in fast enough. Here's the hook you need to tattoo on your decision making. Don't stare at one screen and call it truth. Watch the gap between markets. Shanghai isn't just another quote. It's closer to the part of the world where silver gets pulled into manufacturing. Where delivery timelines matter. Where real users don't settle their obligations with narratives. New York, meanwhile, can be a different game: deeper leverage, more rolling, more hedging, more positioning, more ways to express an opinion without touching a bar of metal. In a calm regime, these layers stay stitched together. Arbitrage does its job. The gap closes. Everyone congratulates the efficiency of markets. But in a stressed regime, the stitching starts to tear, and the tear is the message. When the spread opens, the script treats it like a live diagnostic, not a cute statistic. Physical demand can bid up metal where it matters while paper pricing lags. Gets smooth, or gets managed, by liquidity and positioning. Not because anyone needs a conspiracy to explain it, the plumbing is enough. Futures can absorb pressure through paper supply, through hedges, through rolls, through participants who are structurally short and structurally comfortable as long as the system stays liquid. But once the physical layer starts paying up, you're watching a different kind of force enter the room. Scarcity of immediate, deliverable metal. Scarcity of the right bar form in the right place. Scarcity of time. And scarcity doesn't negotiate with your chart pattern. This is where silver stops behaving like a calm commodity with supply waiting in the wings and starts behaving like a stressed instrument that can gap, jump levels, and trigger forced reactions. In that environment, price movement isn't a smooth staircase, it's a sequence of air pockets. The moment sellers step back, price doesn't climb, it snaps. It teleports to the next pocket of liquidity. That's when you see the violent candles that look irrational until you realize the market isn't voting on a story, it's clearing an imbalance. And the spread is the first proof that the imbalance is physical, not just speculative. So treat this like a case file. Step 1. Establish the anomaly, the price action and the gap. Step 2. Ask who gets forced when the gap stays open, who has to source, who has to hedge, who has to cover. Step 3. Connect the divergence to constraints that don't care about opinions, delivery, inventory, fabrication, shipping, financing, because once you see that spread as the signal, the headline becomes what it really is, the aftershock, not the earthquake. If the spread is the signal, then the next question is brutal and simple. Which side of that spread is closer to reality? Because once you stop worshipping a single headline quote, you're forced to rank the layers. And this is where Shanghai matters, not as another price, but as something the script treats like delivery reality. A premium in Shanghai isn't automatically a prophecy. And it isn't random noise either. It's a map of where buyers are willing to pay extra for metal that actually shows up. In a region that sits closer to the factory floor, closer to end-use demand, closer to the part of the supply chain that can't settle with clever paper. Think about what a premium really is. It's not a vibe, it's a confession. It's the market admitting that spot is not the same thing as available. When Shanghai trades higher, the script reads it as a live broadcast. Someone, somewhere, is choosing certainty over theory. They're paying for immediacy, for the correct form of metal, for a supply chain that doesn't break when you apply pressure. And the key word is persistence. A momentary gap can be a glitch. A premium that sticks is a stress test failing in real time. Here's why that matters. Arbitrage is supposed to erase these differences. In a clean, frictionless world, higher prices in one market pull supply from another until the gap collapses. But arbitrage isn't magic. It's a process with prerequisites. You need metal that can be sourced and sized. You need it in the right bar form. You need it insured, shipped, financed, cleared, and delivered fast enough that the trade still makes sense. Remove any one of those conditions and the easy closing trade becomes a messy, slow, expensive problem. Thin inventories mean there isn't much slack to pull. Slow logistics mean the clock works against you. And wrong form matters more than people want to admit. The metal can exist somewhere on paper, but if it isn't in the right shape, the right purity, the right vault, the right jurisdiction, then it's not the supply you need today. It's potential supply, and potential supply does not close a premium. That's why the script treats Shanghai's premium as evidence, not commentary. If it persists, it's telling you the physical market can be tighter than the futures tape implies. And once you accept that, the argument escalates on its own. When the spread widens during a momentum move, it's not just speculation chasing candles. It's the physical layer pulling away, and every inch that gap opens is a warning that the paper layer will have to catch up later. Under worse conditions, often violently, once participants realize they can't source real supply at the quoted levels. Once you accept that the physical layer can pull away, that a Shanghai premium can stick because real metal can't be summoned on command, the next part becomes inevitable. Because a persistent spread doesn't just sit there as a statistic. It changes behavior. It turns positioning into pressure. It turns normal trading into triage. And that's where the mechanical engine kicks in. Thin liquidity plus forced buying creates air pockets. This is the part most people misunderstand because they picture markets like escalators, steady steps, orderly progress, clean support and resistance. But in a stressed silver tape, price doesn't climb. It teleports. Not because the laws of finance break, but because the order book is shallow at the exact moment everyone needs it to be deep. Big jumps happen when there's a shortage of willing sellers at key levels. The market reaches for liquidity, doesn't find it, and the next available offers are simply higher. That gap between where price is and where sellers exist is an air pocket. When price hits it, the candle doesn't crawl upward, it snaps. And once the first snap happens, the second mechanism starts feeding on it, forced flows. An initial push higher isn't just a number on a screen, it's a trigger. Stops get hit, shorts get uncomfortable, risk systems wake up, margin requirements tighten, and suddenly, participants aren't buying because they want to. They're buying because they must. Some are covering shorts before they get squeezed further. Some are hedging exposure as volatility spikes. Some are obeying risk limits that were set months ago for calmer conditions. The script treats this as the real accelerant. Markets move fastest when choice disappears. Then comes the loop, the part that makes the move look impossible from the outside. A push-up creates fresh constraints, more margin calls, more stop-outs, more hedging demand, more dealers needing to rebalance. Those constraints create more buying. That buying lifts price into the next thin zone. Another air pocket opens, another teleport, in a squeeze-like setup. The market behaves less like a continuous auction and more like a sequence of forced resets. Like the system is repricing in jumps because it can't clear the imbalance smoothly. Notice what the script is not doing here. It's not selling you a target. It's not promising a date, a top, or a magic number. It's doing something more useful. Explaining why a seemingly small imbalance, a little spread, a little tightness, a little positioning, can produce outsized candles that look irrational until you understand the plumbing. Because when liquidity thins and forced buying arrives, the market doesn't need a huge new buyer to move. It just needs the old sellers to step back for one heartbeat. And in that heartbeat, price doesn't walk, it jumps. Those air pockets and forced resets explain how the tape can move like it's possessed. But after you understand the engine, you still have to answer the harder question. What's the engine running on? Because microstructure can amplify a move, but it can't invent a shortage out of thin air. That's why the narrative pivots from mechanics back to matter, to the physical indicators that decide whether this is a paper tantrum or real supply event. And the first place it tells you to look is not another candle. It's the messy, unglamorous truth, premiums, availability, and who can actually deliver. Premiums over spot are the market's lie detector. They're what happens when the posted reference price meets the real world and loses. Spot can print clean and calm while the physical channel is screaming. Because spot is a quote, not a promise of immediate metal in your hands. In your region, in the form you need, at size. The script treats this as the critical misunderstanding that burns retail and embarrasses professionals. They see a number and assume it represents abundance. But the physical market doesn't care about your number. It cares about inventory that can be allocated, fabricated, and delivered. And when that pipeline tightens, premiums rise because the market is pricing certainty, not theory. Then comes the second signal, availability, especially of specific bar sizes and forms. This is where supply exists becomes a meaningless phrase. Metal can exist in the wrong shape, in the wrong vaulting system, under the wrong contract terms, in the wrong jurisdiction, or already spoken for. A bar in one warehouse doesn't automatically solve a shortage on the other side of the planet. A refiner's output is not the same thing as ready-to-ship inventory. And a headline saying, "There's plenty of silver in the world," is irrelevant if the only silver that matters is the silver that can be delivered into the channel that is currently demanding it. The script's point is sharp. Available supply is not theoretical supply. Theoretical supply is what you cite in an argument. Available supply is what you can actually buy without waiting, begging, or paying up. Here's why this becomes the ultimate constraint. Industrial users can't run production on paper promises. A manufacturer doesn't keep a line moving with rolling a futures contract. Solar panels don't get soldered with sentiment. Electronics don't ship because a chartist drew a bullish pattern. At the end of the chain, someone needs metal that meets specs, in a deliverable form, on a timeline that matches operations. When that user shows up and the channel can't produce the material at the posted reference price, the system starts revealing its limits. The paper layer can stretch reality for a while, through hedges, through leverage, through netting and settlement conventions that work beautifully in normal times. But in stress, the physical layer sets the boundary conditions. It draws a hard line. Either the metal arrives, or the market must reprice until it does. That's the thesis tightening into a verdict. The rally isn't just speculative excitement bouncing around a screen. The spread hinted at it. The air pockets explained the velocity. But premiums and availability are where the narrative claims the move gets validated. In the physical market's willingness to pay up. And in the growing difficulty of answering the simplest question in commodities. Not, what's the price? But who can actually deliver? The mechanics explain the speed. The order book explains the teleports. Forced buying explains why the candles look unreal. But once you've seen that engine, you still need the fuel story. The part that decides whether this is a quick paper flare-up or a regime that can keep burning. And this is where the narrative turns to the excuse everyone reaches for in commodities. The line that sounds logical until you test it: just mine more. The script's response is blunt: supply doesn't work like an app. Mining and refining are not on demand. In a normal market, higher prices eventually invite more supply. That's the textbook. But the timeline is the trap. A mine is not a faucet you open because the chart looks bullish. New projects take years just to move from discovery to feasibility to financing to permits to construction. And permitting alone can be a multi-year slog that ignores your quarterly price spike. Even existing operations can't simply double output because silver is hot this month. Grades decline, equipment is scheduled, labor and energy are constrained. And expansion requires capex that gets approved like a marriage, not a trade. The supply response is slow by design, because the physical world is slow. Then comes the second constraint that makes silver especially brittle. A meaningful chunk of supply is byproduct driven. Silver isn't always mined because someone wants more silver. It often comes out of the ground because someone is producing copper, lead, zinc, or gold, and silver rides along as a passenger. That matters because it breaks the clean, price up right pointing arrow supply up logic. Silver can rally hard and still fail to trigger an immediate wave of new production if the primary metal economics don't justify expansion. In other words, higher silver prices don't automatically flip a switch in the places where silver actually originates. The script uses this point to show why the market can feel like it's outrunning its own replenishment. The thing you need more of is not the thing the system is optimized to produce. And it's not just mining. Refining capacity and fabrication constraints add friction. Even if raw ore output improves, you still need processing throughput, the right forms, the right sizes, the right standards, and the logistics chain that turns metal somewhere into deliverable metal here. If inventories are already being drawn down, if the pipeline is being fed by stockpiles instead of fresh flow, that drawdown can mask the problem until it doesn't. When the visible cushion thins, the market's balancing mechanism changes. It stops being supply will rise to meet demand, and becomes price must rise enough to ration demand or force inventory release. That's the structural backbone of the argument. Demand can surge or stay stubborn while supply stays rigid. And when that happens, volatility isn't a personality trait of silver. It's a predictable outcome of a system that can't respond quickly once the pressure hits. Once you understand that supply can't respond on command, that mines don't scale with your candle chart and refining doesn't spread because social media is excited, you start to see why stress regimes get dangerous. The system loses its cushion. Inventory becomes a finite bridge. And when that bridge starts to look thin, the conversation shifts from price discovery to something more primitive: trust. This is where the paper versus physical divide stops being an internet slogan and becomes the central fault line of the case file. Leverage, layered claims, and the limits of confidence. In calm conditions, paper instruments are brilliant. Futures and derivatives let producers hedge, let users lock in costs, let speculators provide liquidity, and let risk get transferred at scale. Most of the time, it works because most participants don't need the metal. They need exposure. They need a price. They need a contract they can roll, offset, or cash settle. In that environment, layers of claims can sit on top of a smaller base of physical metal because the system is built on netting. Longs and shorts cancel each other out. Positions get closed, rolled forward, or settled financially. The machinery runs smoothly because the implicit assumption holds. Delivery is available if someone truly needs it. But almost no one truly needs it. A stress regime challenges that assumption. It doesn't require everyone to demand delivery. It only requires enough participants to care at the same time, enough industrial pull, enough inventory fear, enough "I want certainty, not exposure." That's when confidence becomes the scarce resource. Suddenly, people start asking questions that don't matter in a normal market. Where's the metal? What form is it in? Who controls it? How fast can it move? What are the rules if everyone tries to stand for delivery at once? Those questions sound paranoid until the physical backdrop is tight, and then they sound rational. Because tightness forces the issue. When the pipeline is constrained and supply can't ramp, paper claims look less like efficient plumbing and more like a stack of receipts. They can all be valid on paper, but they can't all be redeemed at the same time without someone paying up for priority. That's the moment the narrative is aiming at, not the daily tick-to-tick volatility, but the regime shift where the market starts pricing certainty. Premiums appear not just because metal is scarce, but because trust is scarce. Participants will pay more for what they can verify, allocate, and receive, and they'll discount what depends on smooth settlement assumptions. This is why repricing can be abrupt. It's not gradual, fundamentals. It's a confidence boundary being exposed. The system can stretch reality for a while through rolls, offsets, and cash settlement, but if enough players decide that paper is not the same as metal, the market is forced to answer a binary question. Can the promised supply be delivered at the posted price? And when that question becomes mainstream, the tape behaves differently. Price stops being a polite auction and becomes a referendum on settlement credibility. That's the case file risk, not a noisy day, but a market that wakes up and starts questioning its own delivery assumptions. Once confidence becomes the scarce resource, the market stops acting like a single chart and starts acting like a system of connected stress points. That's why the script refuses to treat silver as an isolated event. It ties the move to gold, because in a real regime shift, the metals complex moves like a family. But it also makes a sharper claim: they move together. And silver is the one that overreacts when the room gets tense. Gold is framed as the signal. When gold grinds higher with authority, the narrative reads it as monetary anxiety made visible, a quiet vote against comfort. Against, everything is fine. Against the idea that policy can tighten forever without consequences. Gold doesn't need a factory order to rise. It can rise simply because capital wants an exit from uncertainty. It's the scoreboard for confidence in currencies, in rates, in the long-term cleanliness of the balance sheet, in the script's logic. Gold is the slow, heavy door swinging on macro hinges. Silver is different. Silver is the lighter door, the one with the loose hinge and the draft behind it. It's the higher beta sibling that doesn't just move, it snaps. And the reason isn't superstition. It's structure. Silver lives at the intersection where macro flows collide with industrial reality. When gold's strength brings attention to the precious metals complex, silver is often the instrument that catches the marginal flow, and if the physical backdrop is already tight and liquidity is already thin, that marginal flow doesn't get absorbed smoothly. It detonates into air pockets, forced hedges, and violent resets. This is where the script's earlier points fuse into a single bridge. Gold can rise on macro flows alone. Silver can spike when those macro flows arrive into a market that doesn't have slack. Smaller depth means it takes less capital to move silver meaningfully. Heavier industrial pull means there are real-world users who can't wait for a better entry if supply chains are at risk. And the paper versus physical fault line means that when attention and anxiety rise together, silver becomes the place where settlement assumptions get tested under speed. That's why silver can look irrational compared to gold in stress. It's not irrational. It's leveraged to the same fear, but expressed through a more fragile plumbing system. So the script uses gold as the context and silver as the amplifier. Gold says, macro pressure is building. Silver says, and the physical layer can't absorb it quietly. That linkage is the point. The silver move isn't just a one-off squeeze story or retail frenzy. It's part of a broader precious metals dynamic that tends to appear when confidence is wobbling. And once you see them as a pair, gold as the signal, silver as the overreaction mechanism, you can feel the narrative setting up the final escalation. Because if both metals are repricing in the same direction, the question stops being, is silver volatile? And becomes something far more uncomfortable. What exactly is the market losing confidence in? If gold is the signal and silver is the overreaction, then the next move in the script is unavoidable. It stops talking like a trader and starts talking like a historian. Because at that point, the question isn't, what's the next level? It's, what kind of world produces this behavior? This is the, so what, moment. The macro escalation where the narrative widens the lens and frames metal's strength as a symptom of something bigger: debt pressure, currency confidence, and a system that looks stable right up until it doesn't. The script treats fiat confidence like a reservoir. Most days, it's full enough that nobody thinks about it. You swipe, you settle, you roll contracts, you refinance, you assume the plumbing will hold. But debt changes the physics. Debt doesn't just sit there as a number, it becomes a constraint on policy. The higher the load, the more every decision turns into a trade-off. Fight inflation and risk breaking growth. Or protect growth and risk debasing purchasing power. Raise rates and stress the system. Or cut rates and admit the currency must carry more of the burden. In that setup, the market isn't just pricing a metal, it's pricing the credibility of choices. That's why the narrative calls precious metals a scoreboard. When confidence erodes, capital doesn't need a manifesto. It needs an exit. It seeks assets that don't require permission. Don't depend on a counterparty's balance sheet. And don't get diluted by policy math. Gold is the cleanest expression of that impulse. Silver is the messy, volatile expression, the one that also gets pulled by industrial reality. Together, they become a visible proxy for a quiet shift, from trusting promises to paying for hardness. And this is where the script blends mechanics with worldview. It argues the system can paper over imbalances for a long time, not as a conspiracy, but as a function of financial engineering. Rolling debt, extending maturities, smoothing shocks with liquidity, settling in cash, netting claims. All of that can keep the machine stable while stress accumulates underneath. Until one day, the system hits a boundary condition, inventories get thin, spreads open, confidence wobbles, and the market stops pricing in gradients. It reprices in jumps, not gradual adaptation, sudden recognition. This section is intentionally rhetorical because it's designed to change how the viewer feels about the move. Earlier, the script proved the anomaly and explained the engine, the spread, the air pockets, the forced flows, the physical constraints. Now it argues why it matters beyond silver. It frames the move as a potential marker of transition in financial conditions, a shift in risk perception where people start treating hard assets less like a trade and more like a response. Not because the end is guaranteed, but because the incentives are becoming clearer. When policy is trapped by debt and confidence becomes fragile, the market doesn't politely wait. It starts voting, and precious metals are one of the first ballots you can see printed in real time. Once the lens goes macro, it's easy to get intoxicated by the story. Debt spiral, currency trust, system stress. Big words that make every candle feel like history. But the script doesn't end there for a reason. Macro framing without a method turns into doomscrolling. So the close snaps you back to discipline. Not a prediction, not a target, an instruction. Because if this really is a regime where confidence and plumbing matter, then your edge isn't guessing the next number. It's watching the signals that tell you whether stress is rising or fading. Start by demoting the headline. A headline candle is the result. The system leaves clues earlier. The first clue is the spread, the gap between markets that are supposed to stay stitched together. If Shanghai leads and that premium persists, that's your warning that delivery reality is pulling away from paper comfort. If the gap collapses quickly and stays closed, that's the opposite signal. The stress is being absorbed. Arbitrage is functioning, and the market is regaining normality. The spread isn't a meme. It's a pressure gauge. Next clue. Physical premiums over spot. Premiums tell you whether the quoted price is actually clearing real metal. They tell you whether buyers are paying for certainty. Rising premiums when the tape looks fine is often more informative than a green day on the chart, because it points to constraint in the real channel. Falling premiums can be the earliest sign that the pipeline is loosening, that supply is showing up, that urgency is cooling, that the physical layer is no longer forcing repricing. Third clue. Inventories and drawdowns. You don't need to romanticize it. Inventory is buffer. Drawdowns are the system spending its buffer. When the buffer is thick, the market can tolerate shocks without repricing violently. When the buffer thins, every surprise becomes a liquidity event. The point isn't to worship one dataset, it's to understand the direction and the context. Are stockpiles being tapped to meet demand? Or are they rebuilding? Is the market leaning on yesterday's metal to satisfy today's claims? Fourth clue. Signs of forced buying, the microstructure fingerprints. Air pockets. Sudden vertical moves through multiple levels. Fast reversals that look like manipulation, until you remember how stops, margin, and risk limits work.